Welcome to the Morning Outlook. I'm Sage. You're watching Kalkine TV. Hope you're keeping well this morning. And here's some news to help with your day of trading. The Australian market is expected to open 0.5% higher on the back of the rebound in the United States share market last night. And this week the US market has experienced consecutive days of losses. Thursday's close saw a rise in the Dow Jones index of 87 points or 0.3%, making up some of its 306-point loss. Gains were made in the S&P 500 index of 0.4% and the tech-heavy Nasdaq experienced a gain of 0.1%. US Treasuries traded on a mixed note Thursday. 4 out of the 12 sectors traded in the green, energy minerals being up the most, 28.93%, and health services following behind, being up 9.21%. The biggest laggards were transportation and commercial services, down by 8.96% and 8.7% respectively. The Federal Open Market Committee FOMC members were all in agreement that a hawkish stance was required to battle the shrinking balance sheet, and the US 10-year yields were up by 4 points to near 2.65%, but the US 2-year yields dropped 4 points to near 2.46%. The Russia-Ukraine war continues, although many global dignitaries see the actions of Russia's President Vladimir Putin as war crimes against Ukraine. The ongoing conflict continues to increase the risk of stagflation, where wage growth is not able to keep up with the rising costs of living. The major US stock indices are all down by 5% to 12% already this year, with the Nasdaq Composite leading the declines. And although Russia's ruble has rebounded to levels before the war began, the turmoil in Ukraine has been going for 6 weeks now, and the death toll of civilians is recorded at 1,563 confirmed, with the likelihood of several dozens more. Many Ukrainian people are being evacuated without choice into Russian territory. Western nations continue to impose what's been called the mother of all sanctions onto Russia and its delegates. The world is expected to see this war in Ukraine to last several years, it was reported by Bloomberg. And the Aussie market is down 0.68% so far this week. The ASX has been on a 3-week winning streak, and a higher close today could elongate the gains for the ASX 200. Australians are also to expect more interest rate rises over the coming months to combat the national deficit as the road to the May federal election ramps up. The US initial jobless claims dropped to a 54-year low, reaching 166,000 last week, a reduction of 5,000 claims. However, a rise to $41.82 billion in consumer credit was reported in February. On to Europe now. The European share markets closed down on Thursday. The pan-European STOXX 600 index declined by 0.2%, leading the losses, with a 1.2% drop were the insurance stocks. And the European Central Bank proved policymakers were in consensus over the need to fight against the rising inflation with a reduction in monetary stimulus proceedings. The German DAX and UK FTSE indexes also slid 0.5%. Major miners Rio Tinto and BHP both dropped in the London trade at 0.3% and 0.7% respectively. In the Asian markets, the Japanese Nikkei added 0.89% to reach 27,122.81, and Hong Kong's Hang Seng dropped 1.23%, declining to 21,808.98. Companies in focus, shares of HP were popular, with increased volume of the traders causing the stock to rise 14.8%. The news of Warren Buffett's Berkshire Hathaway acquisition of $4.2 billion or 11% stake in the company, formerly known as Hewlett-Packard, spread. Other gainers included Constellation Brands and Lamb Western Holdings, who reported positive earnings. Pfizer gained 4.3% on the news it will acquire ReViral in the $525 million deal, and Microsoft also rose by 0.6%, Target rose by 5.59%, and Levi Strauss shares also saw gains, whereas Twitter's shares pull back 5%. And on to the global oil prices. The global oil price dropped about 5% Thursday as the Eurozone grapples with further sanctions on the Russian energy exports, with the Paris-based International Energy Agency announcing they will release 120 million barrels of strategic oil reserves and 60 million from the United States, which saw a drop of 5% in the oil price, and some energy players as well, as traders reassess their open positions. And the Brent crude dropped to $100.58 a barrel, with a reduction of 49 cents US. And the US NYMEX crude price shed 0.2% or $20 US to reach $96.03 a barrel. Onto the base metals. The base metals prices were mixed on Thursday as China is experiencing its worst COVID-19 virus outbreak in 2 years. They are attempting a zero COVID policy with strict isolation and lockdown restrictions in place. Zinc and aluminium were the biggest laggards, dropping 2.1% and 1.6% respectively. Nickel, the metal that is popular for electric vehicles manufacturing, rose however by 0.7%. And the gold futures price jumped to $1,937 an ounce, being up $14.70. Spot gold was positioned at $1,931 an ounce as the US markets closed last night. And the iron ore futures price shed $3.43 or 2.1%, down to $156.64 a tonne as investors assessed the potential fallout from the COVID-19 outbreak being experienced in China. South 32 made an announcement regarding their senior unsecured notes due 2023 with the pricing of $700 million. The notes will pay interest on 14th of April and 14th of October each year at a rate of 4.35% per annum. Shell also reportedly will be writing off close to $5 billion from their P&L sheet after they have severed ties with Russian sources. And companies set to pay eligible shareholders today include $WTC, $LNK and $Qube. UN has made the decision to suspend Russia from its ledger as part of the human rights body as it continues to invade Ukraine and the death toll of civilians increases. It's worth noting that reportedly more Russian soldiers have died in the last 6 weeks than the total of US soldiers' deaths in the Gulf War. And the annual general meetings are being held by Rio Tinto and Oz Minerals today. That sums up the morning outlook for you. Hopefully your day in trading goes well. Keep watching Kalkine TV. We have more market insights and a bunch of shows lined up for you. This is Sage signing off for now.